looking at intangible assets. So intangible assets are non-current assets which do not have any physical substance. So you can't see them, you can't touch them. So it could be a long-lived legal right that the business has. It could be a competitive advantage that the business has over others. So when we did impairments, I told you about definite life and indefinite life intangibles. So let's put that on the board here. So you could have intangibles with a definite life or indefinite life. So let's look at patents, copyrights, licenses, franchise, leasehold improvements. So all these are intangible assets with a definite life. You know for how long they're going to last. But a trademark, that's an example of an indefinite life intangible. You don't know how long it's going to last. I'll give you an example of Coca-Cola. We don't know whether it's going to last for the next 20 years, next 50 years, or the next 500 years. So that could be a trademark. Now, all the intangibles that I have on the board now are identifiable intangibles. So when we're looking at patents, copyrights, licenses, franchise, leasehold improvements, all these, they are intangibles with a definite life and they are identifiable. Trademark, though it's got an indefinite life, it's still identifiable. By identifiability, we mean either they are based on contractual or legal rights, or they are separable. That means you can separate them out from the entity and sell them, transfer them, license, or even exchange them. So guys, all these are identifiable intangibles. Now, when you're looking at unidentifiable intangibles, we are talking about goodwill. So goodwill is an intangible asset which has got an indefinite life. We don't know how much, and it's unidentifiable. So guys, we have done this classification, and this would help you understand the classifications of definite and indefinite life, also identifiable and unidentifiable. Now, when you're looking at intangibles, let's say you go out and shop for them. That means you acquire them externally, and you acquire only the intangible. You're going to capitalize them at cost, the amount that you paid to buy them. But when you acquire intangibles as part of a business combination, you have intangibles at fair value here. Basically, whenever you're doing a business combination, all the assets that come in at fair value, and then the residual, that becomes goodwill, or unidentifiable indefinite life intangible asset. Now, how about internally developed intangibles? Now, we'll talk about this as we move on with this section, but only certain costs in case of internally developed intangibles may be capitalized. When we're looking at goodwill, so when you're buying a business, you've paid a purchase price. From that, you subtract the fair value of all identifiable assets. So all identifiable assets, intangibles, and that residual is goodwill, and that's why it's unidentifiable. So once you have your intangibles on your balance sheet, then you would want to amortize them. But you can't amortize indefinite life intangibles. You can only amortize intangible assets which have got a definite life. So you know how long they're going to last, and over that period you're going to amortize them. So definite life intangibles, you're going to amortize them over shorter of legal or useful life. Indefinite life intangibles, you don't know how long they're going to last, so you can't amortize them. Can't amortize. You could only test them for impairment. So you have an annual test for impairment for indefinite life intangibles. For definite life, you amortize them, plus if you feel that they are impaired, then naturally you also recognize an impairment loss. So guys, you capitalize your intangibles, you amortize the definite life, test for impairment, both definite and indefinite life, and then you can also sell them, exchange them. So let's say you're selling off an intangible, similar to tangibles, you could have a gain or loss on sale. So let's look at these basics on the book. So we got various ways of classifying intangibles. You could classify it by form. So knowledge-based intangibles, legal rights-based intangibles, and goodwill. You could have identifiable versus non-identifiable intangibles. Expected life. Highlight definite life and draw an arrow and write amortized over shorter of legal or useful life. Next, highlight indefinite life. Now for indefinite life intangibles, write don't amortize, but test for impairment every year. Now intangible assets, they could be externally acquired or internally developed. Now make a table on the bottom of this page. Draw two columns, identifiable, unidentifiable, and two rows, definite life, indefinite life. Now for the row for definite life intangibles, under the identifiable column, write patent, copyright. So two good examples of definite life identifiable intangibles. In the row for indefinite life, under the column for identifiable, write trademark, because trademark, that's an indefinite life identifiable intangible asset. For indefinite life unidentifiable intangible, write goodwill, because goodwill, it's got indefinite life and it's unidentifiable. Now let's start with looking at knowledge-based intangible assets. And first, let's look at R&D. Now this stands for research and development. Now research, that's the discovery of new knowledge. Development is the application of that knowledge into business. So R&D could be new technology, it could be development of a new model or prototype. Now because of the high degree of uncertainty around R&D, the rule for R&D is expense when incurred. You don't capitalize it, you simply expense on your income statement. So there is no intangible created for R&D. Now the exception is, as part of R&D, if you procure tangible or intangible assets which have alternate future uses. Let us say you buy an R&D equipment which later could be used for production testing purposes. Now that equipment could be capitalized on the balance sheet. But the thumb rule or the general rule is expense R&D, expense research and development. So if you're doing R&D, basically what happens is till the time the production commences, all your R&D is expensed on your income statement. After production commences, all your cost becomes inventory and is expensed as cost of goods sold as you're selling the product. Now, we got knowledge-based intangibles, and we're starting with looking at R&D, research and development. Highlight research is discovery of new knowledge and development is conversion of the knowledge. Highlight expensed when incurred, do not capitalize. Next sub-bullet, put a box around not treated as R&D. So what's not R&D? Highlight R&D performed for others under contract. Now in this case, what you do is you match the cost with revenue using the percentage of completion or completed contract method. Commercial production or activity or seasonal, highlight routine or troubleshooting activity. These are not R&D. Highlight quality control, not R&D. Market research, again, not treated as research and development. Let's now look at computer software. So if you want to draw a lifeline for computer software, I could do that like this. and we do a lot of R&D before we get the software up and ready. So that is all expense. So R&D is expense. After your R&D, you reach a point where technological feasibility is established. So under R&D expense, you could have the expense for program design, there could be coding, testing. Till the time a detailed design or a working model is ready, technological feasibility. Now, after this point, all your expenses like coding, testing, product masters, all those expenses may be capitalized on your balance sheet as a software cost. So these would be software costs capitalized. Guys, note, this is only after technological feasibility has been established. Before that, everything is an expense as R&D, research and development. Now, as you go on, you keep working with it. At a point in time, market feasibility would be established. So there would be market feasibility, and then you would also release the software along with the market feasibility. After this point, all your expenses, those are basically production costs. So let us say you would have to duplicate the software, create a lot of CDs, let's say, package the CDs, provide trainings. So all that would be your production costs, which could be cost of goods sold if it's sold during the year, which would be inventory if it's unsold. So it'll go to your balance sheet if you haven't sold the duplicated CDs, and cost of goods sold for all the CDs that you've sold. So guys, understand, before technological feasibility, it's R&D expense. After technological feasibility is established, it's software cost which is capitalized. After it's released in the market, you're going to have production costs, plus now you're going to amortize these software costs. So the software costs that were capitalized would now be amortized. So plus amortization of software costs. Now we'll look at this on the book, but this amortization, this could be the greater of the straight line method amortization, where you amortize the software cost over the estimated economic life of the software, or the unit of sales method. So it's basically how much you expect this software to sell in the market versus how much you sold this year. So we'll look at an example in the book. So guys, expense it before technological feasibility, capitalize it here, and after you've released it, then you start amortizing these software costs that you've capitalized. Now, this is when you've done a computer software for the purpose of selling it out for sale. Now, you could also do a computer software for internal use, for your internal purposes. Now, in that case, instead of calling it technological feasibility, we could also call it probable completion. So let us say you're doing some R&D to develop a computer software for internal use. Now, at this point, it's probable that the software would be complete. So you commit funds. So before that, it's R&D expense. After you commit funds, it's probable to be completed. It becomes a software cost capitalized on your balance sheet. And then because it's for internal use, there'll be no market release, but there would be implementation within the company. So after it's implemented, you're going to expense out all your costs of duplication training, and you're going to amortize these software costs that you have capitalized during this phase. So let's look at software costs on the book now. We're looking at computer software developed to sell, lease or market as a product. So the cost prior to technological feasibility, that's expensed as R&D. What you capitalize, put a box around capitalize, is cost right after an underlying technological feasibility is established. Now that you've capitalized, you need to put a box around amortize. An annual amortization is the underlying greater of, underlying SLM, straight line method, and underlying units of sales method. Looking at the example there, it says Microsoft developed a software with 5-year estimated economic life and anticipated total revenues of $500 million. Revenues in year 1 were $150 million. Now, amortization percentage, so you calculate straight line method, that's 1 by 5, 20%. But units of sales, where you've made sales of 150 million out of a total anticipation of 500 million, that's 30%. So the higher percentage, or 30% in this case, is used for amortization. Now, let's look at the chart that we have on this page. Highlight software developed for sale or lease. And we got highlight technological feasibility and highlight market feasibility. Before technological feasibility is established, highlight R&D expense. After technological feasibility, but before the general release, put a box around capitalize and highlight software costs. And after the product is released in the market, put a box around amortize and draw an arrow from software costs, because the software costs that were capitalized earlier would be amortized after the software is released in the market. Move to page 41, and here we're looking at computer software developed for internal use. Put a box around capitalize, underline development stage. Put a box for amortize and underline SLM, or the straight line method. Looking at the chart there, highlight software developed for internal use. And now we're looking at highlight probable completion and highlight implementation. So in the preliminary stage, all the expense is highlight R&D expense. In the development stage, put a box around capitalize and highlight software costs. After implementation, you amortize. So box amortize and draw an arrow from software costs. Let's now look at legal rights based intangible assets. So we've looked at knowledge based intangibles here. Now we're looking at legal rights. And first, let's talk about patents. So patents is basically a legal right to a product or a process idea. So let's say this iPhone is patented by Apple. So you often hear about Apple, Samsung patent wars. So that's a patent. Now what you capitalize here is, so let's say you went out and you purchased a patent, externally acquired. So in that case, you would capitalize the purchase cost. But if the patent was internally developed, so you developed the product or process internally, all the costs that you incurred in research and development, all that's expensed on your income statement. What you capitalize as patents on your balance sheet is basically the cost of patent application. So this is when it's internally developed. Now, what you also capitalize in case of patents is your costs that you've incurred to successfully defend a patent. Let's say somebody infringed on your patent and you've defended your patent successfully. That is something you could capitalize as patents on your balance sheet. What do you expense? So as I told you, if it's internally developed, you have R&D, that is something you expense. Let's say you're trying to defend your patent, but you lost, you failed to defend. That cost is expense. That's not capitalized because now it's no more a patent. So failure cost, failing to defend the patent. So now next let's talk about copyrights. So patents are product, process, ideas. Now copyrights, these are basically to protect artistic works. You could have books, movies, computer software. So you could look at the Miles LMS the Miles software that you use, even that is copyrighted. So that is basically a legal right based intangibles to protect that artistic work. Similarly, you capitalize, if it's externally acquired, the purchase cost. If it's internally developed, the copyright application cost. You expense any R&D. For both patents and copyrights, whatever you capitalize on your balance sheet, that's amortized over the shorter of legal or useful life. So this one gets amortized. Shorter of legal or useful life. First capitalize it, then amortize it, because these are, guys, all definite life intangible assets. Let's also talk about franchise agreements. So let's say you've taken a franchisee from McDonald's Corporation and you've set up a McDonald's shop out there. So you're now making burgers, giving it out, but that's all McDonald's burgers, and you have a franchise from them. So initially, when you set up shop, you had paid initial fees to McDonald's Corporation. That fees that you've paid is capitalized. So you capitalize initial fee. Now, every year, you also have some continuing or recurring fees that you pay to McDonald's. That is expensed. So you capitalize the initial fee, expense continuing fees. This initial fees that you capitalize is amortized over the useful life. Now, for McDonald's, who's on the receiving end of this franchise fees, they're going to get this initial fees, they're going to get this continuing fees. For them, all this is revenue. So they would recognize revenue when they've done their job. Basically, they've made sure they've done your setup and they're reasonably sure they're going to collect it from you. So now when you're looking at franchise agreements which are capitalized as intangibles on your balance sheet, we are looking at from the perspective of the franchisee. McDonald's, they're the franchisor. You are the franchisee here. Next, let's look at leasehold improvements. So let's say you've taken a place on lease and you've done improvements over that. That becomes a leasehold improvement. So let's say I have this place on lease and I've done this board. Now the board I've fitted in such a way that I can take it away with me after I go away from here. So guys, I really love my board. I can't leave it back here. So I made sure I fitted it in such a way I can take it off. But if let's say I had cemented this board onto the wall such that I couldn't take it away with me when I went, that would have been a leasehold improvement. And in that case, I would have amortized the cost of this leasehold improvement over the shorter of legal or useful life. So let's say the lease life is 3 years and this board is going to last for the next 10 years. I'm going to amortize the cost not over 10 years, but over 3 years, shorter of legal or useful life. Next, let's look at trademarks. So guys, all these are all definite life intangibles which are amortized, and you also test them for impairment if you think they are impaired. Trademark, we know it's indefinite life, only test for impairment as you can't amortize it. Now, trademarks are basically exclusive use of an identifying name for a product or a process. So, Miles CPA review, that's a trademark. Coca-Cola, that's another trademark. We're looking at legal rights based intangibles. So, highlight patents and circle amortized. Highlight copyrights, again circle amortized. Highlight franchise agreements, and here we're looking at highlight initial franchise fees and circle amortized. Highlight leasehold improvements, circle amortized. And the last one, highlight trademarks, that's underline indefinite life intangible. So don't amortize, but put a circle around test for impairment. we're looking at goodwill, which is an unidentifiable intangible asset. Now, goodwill arises on acquisition of another entity at a premium value paid due to certain skills, expertise, brand, relations, etc. that are not separately identified. You need to highlight capitalized goodwill only if it's externally acquired. Since goodwill is an indefinite life intangible, it is highlight never amortized, only tested for impairment at least annually. We're looking at a few miscellaneous topics. Highlight life insurance policy on life of officers, and highlight capitalize the increase in cash surrender value and expense the remainder. Second sub-bullet there, highlight startup cost or organization costs. So as we know, these are not capitalized. You simply expense. So write expense.